What's up, everyone? Welcome to the daily macro update for Monday, November 24th. Not sure why the intro didn't play there. But, anyways, hey, welcome, everyone. I know that last night we did not have a Sunday macro wrap up. Apologies for that. I was doing a little bit of baking in the kitchen, and some chocolate actually fell on the floor. And both cats went at it. Had to take them to the vet. They're okay. They're not hurt. They're fine, but a little bit of a scare there. And so, fortunately, wasn't able to do it, but we can cover a little bit of that here. But we're going to make up for it tonight with our Macro Madness Q&A, which is normally reserved for our Partnership Circle members, but we're going to open that up to all of our members. And so if you guys want to check that out, just go to our website there. But yeah, so we're going to go ahead and get into this here. The reason why I have this graphic here, which is something that I've created that goes through our team's thesis of this no landing, stop, go cycle. And this has pretty much been going on since 2013, where the whole entire process of the Fed and the government coordinating together in order to extend this liquidity issue has been happening successfully for the time being, because there has been just so much pent-up liquidity from the pandemic that they were slowly draining it and injecting it into the system. But now we are at a point where, they're running out of options. Even though there's still plenty of liquidity left in the system, it is slowly starting to run out of ammo there. And so pretty much since 2013 until now, we've gone through this no landing, stop, go cycle where, the market will stop and have a correction because the Fed becomes more hawkish, rate cuts end up pausing, stocks end up having a correction, and that brings up more hard landing fears. And this happens because there's higher inflation expectations. And you see that with the bond market as well as the stock market pricing that in. And then we go to the stop phase. And then from there, we have a correction. Then we have lower inflation expectations, which is where we are at right now. And that is typically a buy some type of environment as long as the S&P 500 remains in bullish trend, which as of right now, it is not. So instead of this buy some phase, we are right now in a wait and watch type of phase. As you can see with the bookshelf behind me there, it is a yellow color, meaning that the S&P 500 is in a neutral trend from bullish, which is a negative rate of change. And whenever something goes neutral in our model, that is a clear sign to just wait and watch to see what happens next. We aren't adding to it, but we might want to be selling some on this pop here, right? Now, we could very well go back to a go phase, which is typically when we have lower inflation expectations, but more optimism comes about because the Fed is going to continue to cut rates and there hasn't been any major cracks in the system, which leads to a dovish Fed, rate cut expectations, stocks having a bounce or a rally, and then you have soft landing optimism, which that happens for a little bit of time, and that increases the inflation expectations once again, which is when you get into this sell some phase and then you go right back around. And so with this iteration, there has been a swirl effect going upward, and that's what has created, this large boom effect that we've been seeing. But the majority of the gains in the stock market that we've seen since 2023 have been really just from the excess liquidity in the reverse repo facility going into the financial markets, causing an effect of ample reserves, as well as the illusion that everything is fine. But this is going to run out of leg room at some point, which it may be happening here soon. There is about $1 trillion left in the Fed's Treasury General account, which I don't think they'll be able to use all of that because they still need to hold cash in their checking account in order to meet any type of obligations in case rollover risk really starts to get out of hand, which it looks like it might be. Then they wouldn't be able to drain as much. And so in any case, there's still more of a chance of this liquidity tightening effect getting worse from here. That's, part of the reason why Bitcoin has been performing so poorly. But getting into some of the macro data here today, a little bit of a light week since it is the Thanksgiving holiday here in the United States. The market is going to be closed on Thursday for Thanksgiving, and then on Friday, we call it Black Friday for shoppers and deals and stuff like that. That's actually going to have a half day. So the market's only going to be open until 1 p.m., the equity markets as well as the bond market. And so pretty short week, low volume. Depending on what type of asset class, that could mean lower volatility or higher volatility. But because there was such a large sell-off over the past couple of weeks, we are seeing a little bit of a bounce here, which we'll get into in a second. But taking a look at the macro data here for today, the Texas Fed manufacturing activity kept on decelerating in November. The Dallas Fed's General Business Activity Index for Texas manufacturing fell to negative 10.4 in November from negative 5 in October, signaling a fourth consecutive monthly contraction in manufacturing activity and the steepest since June. When we take a look at this graph on a chart here, you can see that it's pretty much remained negative for the majority of 2025. We had a slight positive reading in July, but really it's remained negative. And so if we go all the way back till 2021, we can even go back farther, take a look at all the way from now back to 2016. You can see that from 2022 until now, it's pretty much been in a major contraction. And so for all the people saying, oh, we never entered a recession in 2022 like they said we were going to, well, that only means the aggregate has not fallen into a recession. But there are pockets of the economy that have and remain in recession, such as different parts of the country with the manufacturing side. Also with the services side, but really, manufacturing is very sensitive to interest rates. And taking a look at it here, you can clearly see that. And this has pretty much been the deepest and longest contraction period in the manufacturing sector. It won't let me go back max, I guess. But yeah, this has been a very deep recession for the manufacturing sector, and it pretty much continues, although it has gotten less bad since they have been lowering rates slowly. But you really haven't seen a 3-month trending acceleration pretty much since 2021. So the manufacturing sector is clearly having some struggles here, and that is made clear by this Dallas Fed Manufacturing Index. Taking a look at the yield curve here, taking a look at our team's yield curve phase signal indicator in TradingView, you can see that over the past couple weeks here, really the 3-month trend is a bull steepening, meaning that the Fed is starting to signal more that they're going to start to or continue to cut rates. And that has pretty much been the news over the past 48 hours, especially on Friday, because when we take a look at the target rate probabilities for the Fed meeting in just a couple weeks on December 10th, we can see that this had a massive shift over the past 2 trading days. Whereas just last week, there was a nearly 60 or 70% chance that they were going to pause in the December meeting. And now that has reduced to only 15%. Meanwhile, the chances of a 25 basis point cut went from 30% chance all the way up to an 85.1 chance. So something clearly happened in the last 2 trading days. And for us, that was a broken trend in the S&P 500. So you can clearly see that in the target rate probabilities. So they're most likely going to cut rates. And unless you have some crazy level spike in the PCE reading, which comes out hopefully on Wednesday of this week. I think the Bureau of Labor Statistics said that they were going, or it's not the BLS. I forget which one it is. I think it's the BEA, Bureau of Economic, whatever the A stands for. and they're actually going to let out the PCE numbers for September. So we'll see if there's a decent acceleration. That would probably be the only thing to get this more to a 50-50 shot. But at this point in time, it's pretty clear that they're going to cut by 25 basis points in the next couple weeks on the December meeting. And I think I did see tweets about this. I can't verify myself, but there were whispers of Jerome Powell essentially signaling that they are going to cut by 25 points. So that's been the major shift over the past 2 days here. And so when taking a look at the markets here, we have the S&P 500 ETF SPY with the ranges, the trading ranges for today. The market just closed a second ago and it had a decent bounce. When we take a look at volume, this was on an incredibly weaker bounce though. See how the volume drop off happened here? This was the weakest Monday volume day. Let me see. Yeah, this was a pretty weak volume day. Haven't seen something like this in quite some time. November 21st was the last time we saw a weak volume day like this, but it was a decent sized candle. But that pretty much plays into what we were talking about before. And so, what do you do with this information? Well, when you have bounces like this on a decelerating trend, on lower volume, you got to sell it. I know people probably don't want to hear that, but for those who are chasing this green candle, that's the opposite of what you wanted to do today. Today was a great day to clear out any type of losers in the portfolio that may have broken trend, that may have been contributing to a redness over the past couple of weeks. Anything that's been making you losing money that was up today was a great opportunity to get rid of it. And so that's really what the play was today. So hopefully you guys were doing that. If not, it's okay. Just recognize it and say, man, how can I get better here? And one of the solutions that we have for you is that we still have a few spots left in our 6-week Macro Mastery Challenge, where you gain access to our partnership circle. All you have to do is go to the link in the description below, and you can book a time on my calendar where you can have a call with myself, and it's actually me on the call. It's not some stranger, and we can just review what the challenge is all about. But essentially, you're getting access to all of our trainings. You get to learn our model. You get to actually implement it for yourself. This isn't a newsletter. This is a boot camp where we are showing you our process so that you can replicate it. Okay. This isn't any type of newsletter where you get some hot stock and crypto picks. Absolutely not. There's plenty of those out there. You don't need another one. What you need is a strategy that you can replicate. And this is what it looks like in our community here. So you would gain access to something like this, and we have our entire itinerary for the 6 weeks. So if you're interested in that, book a call with me. We can go ahead and chat about it. I think we only have like four spots left out of 50. So after that happens, we'll probably just put a pause until maybe mid or late December, or maybe not even at all, depending. So we'll see. But yeah, 4 spots left, and then we'll close it out. So we'll see who snags those. But yeah, just getting back to what we were talking about here today with this stop go cycle, we'll see if this ends up breaking. As of right now, I don't see that happening, which is a good sign, by the way, only because when I take a look at something like credit spreads, I don't see any type of cracks right now in credit spreads. When zooming out, yes, they've widened a little bit, but you know, when zooming out here, you can pretty much see how credit spreads still remain incredibly narrow and near historical lows. See that? So it's pretty much at the same level as when the market peaked in November of 2021. So I'm not necessarily seeing any type of crazy cracks in the system. At the timing of this video, it looks like this correction was just because of the crazy euphoria that was going on. If you guys like forget, only a few short weeks ago, we had new all-time highs in all the indexes. So, you know, for all the fear that's out there, it's like, geez, People think that the market doesn't do anything but go up in a straight line or something. Incorrect. Same thing with, when taking a look at the SOFR versus IORB spread. Now, this typically gives you a good sense on funding market stress, and it is elevated, but it has not had that spike like it did a couple weeks ago. So I'm not necessarily seeing any type of crazy risk. I mean, this could continue to accelerate because it is above zero. So the risks are definitely not off the table completely, but I'm not seeing anything incredibly like, oh no, this is pretty bad. And then at the same time, you have the volatility index of the S&P 500 almost closing below 20. It didn't close below 20, so this is pretty much at the low end of the range, which again, back to what I was saying beforehand, today was an incredible day in order to get rid of things that have broken trend that will continue to be losers, and you don't want to bag hold those. And then also too, if there were any type of assets that were having a correction, you could take advantage of those at the low end of the trading range as well. One ETF that I've been looking at is LIT, which is the Global Lithium and Battery Tech ETF. This one is in a clear bullish trend at the low end of the trading range on lower volume, and so I was buying a little bit of LIT. Lit. It's lit. So not too many opportunities. It was more of a selling day type of day today. Gold miners, top of the trading range, lower volume, amazing selling day. Man, I mean, this is like a picture perfect, clear things out in the portfolio, get some cash going, pay yourself on some things, don't hold back type of day. So, and that's really the main message that I have for you guys. Bitcoin is having a little bit of a bounce. I'm surprised that Bitcoin has not bounced further from here, but pretty decent volume acceleration over the past 2 days on Sunday and today. So I wouldn't be surprised if Bitcoin does have a bounce to the top end of the trading range, which at the recording of this video is in between 64 and it's not 64, 94 and $96,000 Bitcoin. So I wouldn't be surprised if that happens. Let me just take a look real quick here on this one crypto tool that I like to use in order to take a look at different liquidity zones. 1 second. Here we go. This is on a free website, by the way. So for those who like to track Bitcoin, this is the Bitcoin liquidity heat map, which typically shows where there's large liquidation levels. And so I like to typically look at this on the 1 month or 2 week time frame, whatever shows the strongest near-term liquidation levels. Let's see here if it'll load. Yeah, so I mean, you're seeing a little bit of concentration around 94,000 as well as $97,000 Bitcoin, which is right around where the top end of the trading range is anyway for our model. So again, I would not be surprised if Bitcoin does have, oops, my face is covering it. Let me see if I can switch out of here for those who are watching it on YouTube. Let me just keep on switching. Nope. There we go. There you go. Now you guys can see it. Okay, let's go ahead and get into some of the questions here. Appreciate everyone for joining. Someone asked, please share if now is a good time to liquidate some of my portfolio as I'm very heavy on tech. I can't give direct financial advice, but you've heard what I've talked about over the past few minutes. So I think you got your answer on that. Let's see. Lawrence, how are you? Appreciate you tuning in. Lewis underscore Piol says, doesn't Fed rate cut probability change because of Japan new stimulus package? No. Why do people bring up foreign markets like they are part of the reason why the United States Fed makes decisions? The US Fed isn't making any decisions based off of foreign markets. They don't care. There's only one reason why the Fed is cutting rates, and that only has to do with what's going on in the United States. So if you think the Fed is cutting because of Japan carry trade or whatever, completely false. Which ones are you thinking that are general losers that you would get rid of? I mean, anything that broke trend, so S&P 500, QQQs, small caps, things like that. So, yeah, good question here. Let's take a look at YouTube. What's your view on CPI? Is it cooling down? Yeah, I mean, we've been in the camp of inflation cooling, and we think that's still on the table, which is a little bit of a dangerous point in this late cycle time, because if you have cooling inflation while growth isn't keeping up, then you could have a real problem. But, when just taking a look at the 5-year break-even inflation rate, you can see that over the past 3 trading days that this has come down all the way to the lower bound that we saw back on October 17th, which is showing that you are starting to see some weakness with inflation expectations from the bond market. You have to remember that the bond market is incredibly efficient at pricing in all this data that it's calculating, right? That's why they call the bond market smart money. And so, when taking a look at the bond market and taking a look at some of the other things that we're seeing in the real data, that's what you have to use to make your conclusions. So that, as well as you continue to see oil be in crash mode here. Have you guys seen what oil's been doing over the past couple weeks here? This thing has just been taking hits, which I guess is good for the price of gasoline, but this has had a steady decline and it remains in bearish trend. And so with oil making a series of lower highs and lower lows in a clear bearish trend, you have 5-year break evens coming down. You have some things that are inflation sensitive, like Bitcoin, also in a bearish trend. So, there's a lot of signs that are suggesting that inflation is cooling. And again, the trick has to do with what growth is going to do with this inflation cooling off. Because if inflation is cooling while growth is either remaining stagnant or also coming down, that's more of a recessionary type of environment. And that's typically when Bitcoin's performing poorly, which that's what it's doing right now. And so to me, Bitcoin is giving a macro signal that we could be heading into more turbulent types of winds going forward. And, that with the average, and I don't normally use this, but it is an interesting thing to acknowledge, which is that typically midterm years are terrible for the markets. Again, not saying that should be your case for the reason why you should be bearish heading into 2026. But when you look at everything stacked up, the liquidity issues, we're seeing a little bit of a widening in credit spreads, even though it's not bad right now, it still has come off of the low end of the range. You're seeing things break trend, midterm year. All these things are pointing towards a little bit of a rough start for 2026. So we'll see what happens. But it doesn't really matter, though, because there are bullish trends like healthcare. I mean, healthcare just continues to just rip. Look at this. Look what healthcare is doing right now. This thing is just out of control. Accelerating volume, accelerating prices, chef's kiss right there. That's what you want to see. And what do you do with that information? You buy every single dip. That's what you do. Is there a good healthcare ETF to invest in? Yeah, this one right here, XLV. That's, one of the great ones. There's other ones too, but this one has the highest AUM. Would you say that NVIDIA has broken trend? Yes, NVIDIA is neutral. So again, that doesn't mean completely get rid of it, but that doesn't mean, that we're adding to it. That just means it's in a wait and watch mode. If it does go to bearish trend from here, then yes, you would just get rid of it. Is gold bullish? Yep, gold remains bullish. Any suggestions on which bonds are a good buy right now? Well, the bond market is a little bit weird only because the yield curve remains flat, and bonds, even though you have had a pretty nice little pop up here. So if you were buying things like IEF, which is the ETF for 7 to 10 year treasury bonds, that's been having a pretty decent acceleration over the past, week or so. 2 weeks. And that was just because of the 10-year bond yield coming off of the top end of the trading range, and it remains in a bearish trend. But not all bonds are created equal. Something like a 30-year bond, so the longer you go out on the yield curve, it's not as good as an opportunity. So it looks like what's the best opportunity is the short end of the yield curve. So like the 2-year yield or below. An ETF to express being long something like that would be this, SHY. So let's see. Since November 5th, SHY has popped up 43 basis points, which is a lot for a bond ETF. In that same time frame, well, it looks like IEF is actually up more. Okay. Now, the way that my team and I like to size our positions in bonds is obviously a lot higher than something like equities because it's less volatile. And so you can pump up your position sizing with something like bonds because of that reason. And so a lot of people are like, oh, why are you investing in something and it only goes up 43 basis points or it only goes up 1%? Well, because they're bonds, you can load it up with a lot bigger of a position, which will make those 43 basis point or 150 basis point moves really nice. So, and then if you're someone who doesn't have a large capital, or a lot of capital to work with, I believe you can trade options on these things too. So you just have to weigh the risks and rewards, Is SPY still bullish? Nope. It's neutral. What do you think about Google? Google is actually the best trending mag stock right now. So this thing just continues to rip. And yeah, Google remains in a very, very firm bullish trend. Broadcom having a huge jump today, back to bullish trend. Let's go ahead and change that. Tesla, I know that this had a pop too, but that remains bearish. Amazon remains neutral. Meta, bearish. NVIDIA, neutral. With everything popping, look at how pathetic NVIDIA popped up today. Interesting. JP Morgan, bearish. Walmart, we took to bullish trend, so maybe this was not quite at the low of the trading range, but Walmart's bullish. Microsoft is bearish. Apple remains bullish. Berkshire remains bullish. So there's really only, let's see, one, two. Out of the top 10 stocks, there's only 4 that are bullish trend. That's not really what you want to see, especially with a very high concentration of funds that are in the Mag 7. So it's fragile, that's for sure. Hopefully Google and Apple can continue doing what they're doing. Quick question, between gold and silver, gold is the leader, correct? How would I use that when I see gold taking out a low, silver didn't? That's a good question, and you don't necessarily have to wonder, because all you have to do is take a look at the ratio between silver and gold. Literally take silver and divide it by gold. What's the trend? And right now, silver is in a clear bullish trend versus gold, which means silver is the clear winner as of right now. Now, both are bullish trends, but if you're going to choose one that has a stronger bullish trend, just look at the chart. Since May, silver has been outcompeting gold. And it looks like that bullish trend is remaining intact. Yep, good question. All right, let's take a look at TikTok and then we'll go ahead and clear it out here. I have another call coming up here soon. Why was the market up today? Because it was down on Friday. Let's see here. Sometimes it's not that big of a deal, you know. Things go up after they go down. Did SoFi break trend? Let's take a look. Let's see, actually. Yeah, SoFi did break trend. It's bearish. Why is oil at multi-year lows but not reflective at the pump? Because oil's not gasoline. Is there a good healthcare? We already answered that. Any good silver ETFs? SLV. Yep, SPY's a neutral trend. Yep. That's a wait and watch signal. But all right, we'll go ahead and wrap it up there. I appreciate everyone for joining. Again, if you guys are interested in learning how to implement our process for yourself, we still have a few more spots for our 6-week macro mastery challenge. And so if you're interested in learning more about that, you can use the link in the description below for those that are on YouTube. For those who are on TikTok or on Instagram, just go to the link in my bio and you can check out my calendar to book a call with me and we can review everything from there. But I appreciate everyone for joining. Have a great rest of your Monday afternoon here, and we will catch you in tomorrow's daily macro update. Bye, everyone.